Hello traders, you're welcome to this video. Welcome back to the Forex Geek channel. In this video, we are going to be diving into a crucial topic that often goes overlooked, right? And the topic we're going to be talking about in this video is measuring gaps, right, in the Forex market. So gaps are not just anomalies, okay? They can provide critical insights into market sentiment, okay, and they can also provide insight into momentum and upcoming trends. All right, so if you've ever wondered how to effectively measure gaps and use them in your trading strategy, stick around because we are breaking it all down step by step. Okay, and as always, if you find this video helpful, make sure to smash that like button and subscribe to the channel for more actionable Forex trading content. All right, let us get started. Now, first, let us talk about what gaps are. Okay, in simple terms, a gap occurs when the price of an asset jumps, like we can see what happened here, right? You can see it's quite clear. When the price of an asset jumps or drops significantly, it could be a jump, it could be to the upside, or it could be to the downside. All right, this one is to the upside, jumped up. I'm just checking if I'm going to see a downward gap, right? Okay, you can see we have one here. So a gap occurs when the price jumps or drops significantly, leaving a gap in the price chart. Okay, now this happens when there is a difference between the closing price of one trading period and the opening price of the next. So we can see the closing price, we have the closing price of this trading period around here, and we see we have the opening price of the very next trading period around here, and you can see that we had a gap in between. That is for the sell, right? For the drop. Now, in the case of this jump, you can see the closing price of this day's period, and you can see that this is the opening price of the very next period, and you can see a gap in between. Okay, so while gaps are more common in stock markets, right, they actually do occur in Forex too. Okay, but it's especially during periods of high volatility or after major news events. Okay, now understanding gaps is essential because they often indicate shifts in market sentiment or momentum. All right, now let us look at the different types of gaps you'll encounter in the Forex market. Okay, so the first is breakout gaps, right? Now, just pay attention because sometimes some of these gaps you might not readily find them. Okay, when they occur, if you have knowledge of them, you might know what next to do. Okay, you might know what action to take when you find them, but it doesn't mean that you would always find them. Okay, so the first is breakout gap. I'm just going to be explaining what each of these gaps mean, right? It occurs when price breaks out of a significant level of support or resistance, signaling strong momentum. Now, as we all know, support and resistance levels are areas of rejection, right? For example, we can see that we had a resistance level around here. You can see because there are multiple rejections, we have another resistance level around here. So basically, a breakout gap happens when there is a breakout, then the price jumps. So when you find a breakout gap, you should be able to recognize it, right? Because it usually occurs when there is a breakout from a support or a resistance. So when the breakout occurs, instead of the price, the very next period to just open at the close of the previous period, you will find out that there's going to be a jump. That is, if it is a bullish breakout. If it's a bearish breakout, you're going to find out that there is going to be a drop. For example, here we can see we had a support. So if there was going to be a sell breakout with a gap, a breakout gap, you will notice that there's going to be a drop. Like instead of the breakout candle to open at the close of the previous, there's going to actually be a drop, and you'll find a gap in between. Now, the next gap we're going to be looking at is exhaustion gaps. All right, exhaustion gaps. Okay, now this typically appear toward the end of a trend and might signal a reversal or slowdown in momentum. Now we can see that we had an exhaustion gap around here. Okay, we can see that we had an exhaustion gap around here. So one thing I'm going to tell you to pay attention to is when a gap happens just before a resistance, pay close attention to what happens next, because it could be an exhaustion gap. For example, we can see that we had a resistance around here. Can you see there was rejection here and here, right? Rejection here. So there was actually a resistance around here, and this gap happened just before the resistance. So can you see that shortly after the gap, there was a reversal. So we can see that we had an exhaustion gap here. All right. So how do you identify an exhaustion gap? Pay attention. It doesn't mean that when it happens before a resistance or before a support, it's immediately an exhaustion gap. Just pay attention. Like this one now was not exactly an exhaustion gap because there was a continuation after the gap. Can you see that? There was a continuation. We had a sell right up to this point. Okay. But in this particular case, we can see that a reversal happened just shortly after the gap. Now, the third category of gaps we're going to be looking at is the common gaps. All right. Now, these are small gaps that occur during regular market fluctuations and are less significant. Okay, so you actually find some gaps that might not be as wide as this or as wide as this. Why? Because you can see that these ones were quite wide, right? These ones were quite wide, but it does not necessarily mean that you might not find some common gaps that will not be maybe a little bit wide, but common gaps usually occur during they occur during just regular market fluctuations. Like if you look at this now, I just had to come back to this so we can properly check what category of gap this is, and it seems like this is a breakout gap. I just had to zoom out a bit and I checked and I saw that, as you can see, this is actually a support zone. As you can see, this is actually a support. Can you see that? So it seems like the breakout from this support resulted into this drop, this gap that happened. So this seems to be a breakout gap, while this an exhaustion gap. All right, then a common gap is perhaps this is probably a common gap. As you can see, the gap was not exactly as wide as the other, right? You can see this is probably a common gap that we have here, because the common gaps are usually small. Okay, and it's just regular market fluctuations. So we have been able to identify examples of the three kind of gaps that we have. You can see the common gaps are usually small and just during market fluctuations. It was not necessarily as a result of a breakout or necessarily as a result of an exhaustion. Okay, so each type of gap tells a different story, and knowing how to identify and measure them can help you make smarter trading decisions. Okay, now let us get into the practical part, measuring gaps. Okay, here's how you can do it. The first thing is to identify the gap. All right, look for areas on your chart where there's a visible jump between the closing price of one candlestick and the opening price of the next. Now, secondly, measure the gap size. You can actually use your charting tools, to measure the distance between the two prices. This is your gap size and can be expressed in pips or percentage terms. For example, if you are using the MetaTrader platform, you can see that you can be able to measure it in points. Can you see 400 and something, 186, 300, 400? So we have the gap of about 470 points or so, right? So if you are using another platform, depending on the way it is being measured, whether it's in points or in percentage and all of that. Okay, then the next, context actually matters. Okay, pay attention to where the gap occurs. For example, is it near a resistance or support level? Is it during high impact news event? Okay, measuring gaps isn't just about knowing the size, it's about understanding what the size means in the context of the market. So how do you use gaps to enhance your trading strategy? Here are some key tips. All right, breakout gaps often signal strong momentum in one direction. Okay, like we already talked about, this is an example of a breakout gap, right? And you can see that it signals a strong momentum in one direction. You can use them as confirmation to enter a trade in the direction of the gap. All right. Then secondly, exhaustion gaps, you have to be cautious with these, okay? Because they might indicate a trend reversal. So look for additional confirmation before entering any trade. Perhaps you can look out for reversal candlestick patterns right after the gap, okay? And we can see that we actually had a bearish engulfing somewhere around here, right? Okay, we still had a doji and we had another bearish candlestick pattern, another bearish candle. Okay, so that is it. Now, common gaps, they are usually filled quickly, right? You can see, for example, this, you can see it was filled quickly, right? Just, some fluctuations. The price retraces back, to the close, to close the gap. Right after the gap happened, you can see the price just immediately came down and closed the gap. So this can present short-term trading opportunities. Remember, gaps are not foolproof signals. All right, always combine them with other tools like trend lines, moving averages, or support and resistance levels to validate your trades. Okay, now let's quickly go over some common mistakes traders make when dealing with gaps. The first is overreacting to every gap. All right, now not all gaps are significant. Learn to differentiate between noise and meaningful signals. Secondly, ignoring context. Now, a gap during low trading volume might not mean the same thing as a gap during a major news release. All right. And finally, gaps can lead to rapid price movements. So always protect your trades with appropriate stop loss levels. Okay. Avoid these pitfalls to make the most of your gap analysis in your trading. To wrap things up, measuring gaps is a powerful skill that can give you an edge in the Forex market. Okay. It helps you understand market sentiment, spot potential opportunities, and manage risk effectively. But like any trading tool, it works best when combined with a well-rounded strategy. Practice identifying and measuring gaps on your demo account to build confidence before using this technique in live trading. Alright, so that is it for this video. If you found this content valuable, don't forget to hit that like button and subscribe to the channel for more Forex trading tips and strategies. Also, drop a comment below. What's been your experience with trading gaps? I'd love to hear your thoughts. Thank you for watching, and I will see you in the next video. Until then, happy trading.